You've said that the current deposit insurance framework is a vulnerability for the banking system, that there is a competitive imbalance that favors large banks, and that this increases the risk of bank runs and erodes depositor confidence. Can you talk more about a targeted expansion of deposit insurance for non-interest-bearing transaction accounts, and would that strengthen financial stability within the system?
Congressman, thank you for that very important question, because it is my belief, because there is the belief that big banks, the depositors, will not lose money. During a financial crisis, as we saw in 2023, assets leave small banks. And much of that is what is known as the payroll account. So I think it is very important for small banks to have one non-interest-bearing account that can have a much higher level of insurance so that they are able to retain deposits during a stress period. This is one of the reasons that we have seen assets leave small banks. It is one of the reasons that we have seen 50% of small banks disappear.
Continue along this line of inquiry, Mr. Secretary. A robust banking system with healthy banks of all sizes reduces systematic risk across the entire system. Why is it important that Congress act now on targeted deposit insurance reform, not only for Main Street, but also our financial stability?
Well, again, deposit volatility, which is what you're referring to, is deposits moving during a stress time, does not benefit anyone in the long run.
And one more question on this perspective. Congress should look at giving FDIC authority to raise the coverage level for non-interest-bearing transaction accounts to an appropriate amount that is data-driven and put smaller institutions on a level playing field with larger banks. How would our banking system be safer with a narrow, targeted expansion, such as the one I've suggested?
Again, it would permit the small and community banks to continue competing. It would get credit to our Main Street, and it would stem deposit flight during a period of stress, which is one of the most, or one of the biggest threats to financial stability.
Focusing on a slightly different subject. Sometimes something I've focused on as chairman of the task force on Treasury resilience has been strengthening market stability and liquidity. We saw occasional bouts of Treasury market volatility last year. How would reforms to banking regulations like the liquidity coverage ratio and stress tests incentivize market intermediation for banks and improve market stability?
Again, Congressman, wonderful question, that it brings more of our Treasury market onshore. And as you said, there were periods of stress last year. The market successfully navigated those. At the end of January, we had the third highest volume in the Treasury market, and the bid-ask spreads, very important for the financial well-being of the American people who are invested in money market funds, in bond funds, in their retirement funds. They have stayed right in the center line, and we are at a 5-year low in bond market volatility.
Thank you, Mr. Secretary.